Welcome back to the What's More podcast. I'm your host, Quinton Harris. We're dialed in for episode 180. And I got to tell you, so this weekend, I'm coming back, wrote this episode, and then obviously with the events of Saturday night, I immediately thought, well, I got to pivot and change this episode a little bit today. And so, I started thinking about like what's to be said that hasn't already been said. Like, if you've been looking at any news, you had your face in your phone, you've been listening to anything, you know exactly what took place on Saturday. But I'm sure, like many of us, at some level, there's this high level of just disappointment, maybe even pissed off, worried, concerned about the events that took place on Saturday. And sometimes it's even difficult to like try to bring in a topic of business on top of what just happened here. But at the end of the day, we have to be balanced about what we talk about. And when I look at Saturday, I think there was obviously a lack of balance that happened there. And, there's just no place for that. And the thing for me is, I'll say this, I feel like we need a lot more understanding of one another's opinions. Need a lot more love, a lot less hate. Probably need a lot more God in our lives too than what's going on right now, because the idea of something can get so bad, deteriorate so quickly into a moment like that could possibly been a lot worse than what it is. And by no means do I want to take away from, what happened. And, our hearts go out to the victims that were impacted and the families that were impacted from that. But, if you're listening to this right now, you're probably feeling some sort of kind of way about what happened. And, depending how old you are, you were alive when that happened to President Reagan or you weren't. But this could have also been a 9/11 moment in this contrast. It's such a pivotal change in American history that went down. And I think that, unfortunately, we have so much more media today than we did during those other times, that the fact that it's in your face so much, and the fact that, there's all these different individual footages of what took place, that we're getting so much data so quick, so fast, I think it just kind of adds to the notion of how quickly things can unfold. More importantly, more answers that we get. And that's the same thing that happens in our financial markets as well. And, it's tough to make a transition coming out of what I just spoke about, but it did kind of change and alter quite a few things. First thing is, I think it instilled a higher level of confidence in the markets, that they feel they know who is going to be president now. And when I say they, we're talking about people in the markets. We're talking about major players in the markets. Today, it's Monday the 15th, and here it is. I'm recording this at 5:30 in the afternoon, and I purposely waited to record this later in the afternoon because I wanted to see what happened. Obviously, we like to record these a little earlier, but today the markets have closed. Bond markets closed, and then all the equity markets have closed. And what we've seen is this level of confidence from those markets that they feel they know who the president's going to be, and they think it's going to be Trump. And the reason they believe that, or the reason I believe that's the case, is because you're seeing this huge rally unfold right now, and you're seeing it under the pretense that they know what Trump's economic policy is going to be, and they know the direction that campaign wants to go. And I think another thing you saw from all the footage, and you saw from all of the media outlets, is that this imagery of, Trump obviously bleeding from his ear, the hand being raised right behind the American flag, and standing right up after that happened. I think that imagery is what essentially showed up today in the markets. I think this united front, whether you're with Trump or you're not, or you're with Biden and you're not, it doesn't matter. There was a united front that came from that. And I think the markets today said, okay, we feel more confident today than we did prior to Saturday that is who is going to win the presidency. And we know what those policies are going to be moving forward. Here's something interesting. There was an interview with Mark Calabria on Friday, and that's what my podcast was going to be on today, was that interview with Mark Calabria. And the interview with Mark Calabria, for those who don't know who that is, he was the head of the FHFA, the Federal Housing Finance Agency. So he was the head of Fannie Mae and Freddie Mac. And as you know, those were taken under conservatorship by the federal government during the 2008-2009 era of the mortgage meltdown that happened. And so when they were taking off of the private market into the receivership of the government, or conservatorship of the government, he was essentially the head of that, right? So he was asked independently in this interview. I thought it was interesting. I'm looking at my notes. Here's the question. I'll make sure I got it right. How would each administration's approach to the economy affect the mortgage industry? This, I think, is just one example of how the markets reacted today. And this example has to do with the mortgage industry. this is interesting. Mark Calabria, remember, now he does control the decision making for Fannie Mae and Freddie Mac, specifically said, hey, that's a great question because that's the absolute most important aspect of the two administrations as far as he's concerned. And what he said was this. Without a doubt, he said, while there's differences in the housing mortgage policies, while there's differences, and there are going to be significant ones, he said, here's something to take into consideration. Inflation will be more stable under Trump. Now, what's interesting about that statement is very rarely can you look, I mean, in my lifetime, I can't point to it. Can you look at a presidential candidate and say, well, we have history with that presidency. Like we have 4 years of economic data that we can look at that happened under their watch. We also are getting very close to the 4 years of Biden. So we have at least 3+ years history under his administration as well. And he said, it will be more stable under Trump, and you'll see a decline in interest rates and mortgage rates more than you would under Biden. I thought that was a pretty powerful statement because here's somebody that is the head of the two largest agencies for mortgages specifically say, under Trump, you'll see lower rates, and you'll also see more stable inflation. Now, that's interesting because he said, Trump was kind of blamed for a lot of things. And he said, and I could see how that takes place. He goes, but the one thing you have to understand during that time is that he has more favorable policies to the housing market. And to me, that was kind of a step back because I go, well, okay, here this is on Friday, him saying that. Now, he was peppered with about 14 questions during this interview, all very relevant. Again, I will do that podcast at a later time. But I think his approach and that mindset is what you saw happen today in the markets. And I think it bleeds another question here that's important because I think is this, as this confidence starts to grow. So what I think is this, the bond market today somewhat didn't react as similar. We didn't see this growing wave of wins in the bond market. We actually saw it uptick a little bit. And so the yields got higher and a lot of people anticipated those to get lower today after what happened. But I think that's further confidence and further, I guess you could say reconfirmation from the markets that they believe they know who is going to be the next president. Because here's the thing. I think what we're looking for in the bond market is we're looking from some sort of foreign participation needs to pick up. It's not there yet. But I also think that you're looking at hedge funds, and I think you're looking at large players going, okay, wait a minute. We can get 4.25%, just about 4.25% on a 10-year bond today on Monday for 10 years. So our 10-year note, like when do we start considering we start buying that guaranteed rate of return there and getting in on that before that starts to come down a little bit? And here's an interesting take for all the mortgage people out there. We've talked about this over and again. The Fed doesn't have to lower the Fed funds rate, by any means for the 30-year fix to come down. However, today is the first time on the headlines, on a lot of different headlines, people are calling for a rate cut in July more than they did, let's say, last week. I even saw reports, multiple outlets today, suggesting that if it doesn't happen in July, we could be looking at a 50 basis point cut in September. Now, as my last podcast stated, if for some reason we have a 50 basis point cut in September, that's going to be the cliff that we've been talking about in the mortgage rates right now. That quarter is not going to do it, but that 50 will. And I want to bring a graph up here. And if you're listening to this, tune into our YouTube channel at What's Your One More with the number one. That's at What's Your One More with the number one. Subscribe. We're going to get all of our graphs, everything we put up there. But in this graph, as I'm pulling it up here, I've been talking about this complex formula, this complex situation where rates on the 30-year fixed rate mortgage are much higher than they should be because there's the level of disparity and uncertainty. And in this graph, what I want to show you is this. I want to show you what it normally should be. So what I'm going to do is I'm going to go back in this graph, and you're going to see a pink line on this graph. And this pink line represents early 22 all the way through year-end 22. And at the very beginning of 22, the mortgage discrepancy, the disparity between the 30-year fix and the 10-year spread, their 10-year note, was 1.5. That's 150 basis points. We've talked about that over and over again. Well, if I go back to those same months and I go all the way back to February and March of 2023, that number, it doubled. It became 3.01. We went from 150 to 3.0. That's 300 basis points. If you recall, one of the things, the major thing that opened up the floodgates for that disparity and that market uncertainty was the collapse of SBV, along with two other major financial institutions, creating so much uncertainty in the market. of who's the next bank, where's the next big collapse going to happen, is the Federal Reserve going to backstop this? All of this created a tremendous amount of uncertainty, right? And that uncertainty lived in the market for the entire year of 2023 because we just didn't know what was the next financial ball to drop, what was the next big thing that was going to happen in the market. And that uncertainty was compounded by Fed funds hikes that were happened, and then the actual mandate of just holding the line for as long as they've had to hold the line for, to fight the 2% inflation, and also to see just a slight softening of the labor market. Well, they've got their softening of the labor market right now. They've got their core PCE with a 2 handle on it. They've accomplished, being the Federal Reserve, they've accomplished all of those things they've wanted to do, minus getting just a flat 2.0 inflation reading. Well, as we've kind of won some of these battles as the American economy, we're starting to see that uncertainty disappear. And so instead of being at the 300 basis points, we've made our way down to 262 basis points now where we are right now. So there's about 90 more to go. And that 90 directly represents a drop in mortgage interest rates, just like we've seen a drop in rates to where we are now. And it's nothing to write home about at this point. But if you were to take the current 10-year Treasury today and add 150 basis points to it, just today where we are, market close today, and I'm going to round it up to 4.25. And if you were to add 150 basis points to that, that's 5.75 to 5.875 on a 30-year fixed. That's where we should be right now. And when I talk about that disparity and when I talk about that uncertainty in the market, that's what I'm referring to. And what I'm starting to see happen and what I think happened today and what I believe will happen by the end of this week is that certainty is what you're seeing show up in the equities market. I think is also going to show up in that disparity being removed. And all of a sudden that 90 basis points maybe goes to 45. Hell, even if it goes down from 90 to 60 and we get another 30 back, that's a win. But what I'm getting at is as a lot of investors start to settle into the fact that they believe what events were happening on Saturday night further advanced Donald Trump as a candidate that's leading the pack as of right now, and they believe that he is the man to beat, I think you're going to see less uncertainty in the equity market and the bond market, thus showing lower interest rates because of that uncertainty being evaporated from the bond market. And I mean, let's face it, I think at a time right now, where this country needs more leadership than ever before. And leadership comes in all walks of life. But what I think I saw on Saturday night, what I saw was a group of people that literally did not panic in the wake of multiple gunshots. I saw people that stood up to make sure that the person that they were there to see was okay. Yes, you see film where people are running around on the outskirts of that never made it into the rally. But the people that were in the rally did not panic. They did not scour. They did not run away. And I think it's because they're saying, hey, listen, we want to see if he's okay. We want to see what the person we want to lead our country can do. And I think that's vastly different than what we've been seeing as a country right now, because I think the leadership right now is necessarily not there. And I mean that from this point, we are in a bad financial market. We're being told we're in a good financial market. We're in a bad labor market. We're being told the labor market is strong. And we're also having serious issues of, just general conversation. And any way you cut that, that's not leadership, unfortunately. And I think what you're seeing right now is the markets and also the American public react to that. Now, I know that comment is not going to be favorable with a lot of people on here, but that's just my opinion, and it doesn't mean it's right. And I'll be the first person to say that. But I think what you're seeing in the financial markets reciprocate a little bit of that opinion as well. And this is another thing. When we look at headlines and when we look at content and misinformation, this is really important because I can tell you firsthand that when we say anything, and I mean anything about the President of the United States, and we put Joe Biden's name on there, all of our stuff is usually banned and blocked online immediately, minus YouTube. That to me is something that I think was the biggest wake-up call when we started doing this podcast, because anytime we say something like that, it immediately gets blocked. 2 of our accounts have been discontinued because of that. That is not normal. And the stuff we're saying is minimal. It's what I just said right there. It's nowhere beyond what you see in the media. I think that's a prime example of misinformation. I think it's a prime example of some of the pressures that are put on the general public to hear and navigate some of these media channels and hear some of just the most ridiculous stuff out there, because I think there are things being pushed from both sides, not just one, from both sides. I hope that what we just saw on Saturday night slows that down significantly. And I hope from this that this unites the general public and doesn't divide. Out of multiple texts that were sent to me talking about this, I said my biggest concern is civil unrest, and I hope that is not the case. I hope it's more of a civil unite, because at the end of the day, this stuff's not okay, and we're better than that. And a few people that are mentally unstable and deranged, and time will tell what caused that, is not who we are as Americans. And so I urge people to think differently and accept other people's opinions and try to be more bipartisan than being leaning towards one side. So, guys, look forward to the next episode as we break down that episode with Mark Calabria. I think it's going to be fantastic because he's got so much good stuff in there about the upcoming policies and the impacts to the mortgage industry as well as to the housing market as a whole. So look forward to talking about that. If you're enjoying this episode, please share it. Please 5-star review it. Leave us your comments. We'd love to hear from you, especially on YouTube and on Apple Podcasts. If you'll 5-star review it, subscribe at What's Your One More with the number 1. Guys, I tell you what, is going to be a really interesting next 4 months, not so much because it's an election, because I think we're finally there. We're finally going to get that relief we've been looking for, and it may come in a bigger wave than we anticipated between now and the election. So tune in for more. What's Your One More? Till the next episode. Guys, thanks for tuning in.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live.